Okay, good morning everyone and welcome to MACROACE with your host Tony, going through the CPI data, the sentiment, what to expect for it and what it means and what it could also mean for the Fed as well. So CPI year on year, and this is going to be the key headline figure. Of course, the core data is going to be very important as well. Well, actually all the data is, but let's get into it then. So CPI, first we have to understand what it is. It measures the prices that consumers are paying for retail goods and services, and it shows you, and the way it's constructed, the way it's built up, or the way it's surveyed, is that 26,000 retail outlets, 4,000 housing units in 87 urban areas where prices collected on 80,000 different goods and services. So the key measurements and how it's made up is you have housing, which represents about 42%, food and beverages 14%, transportation 18%, and medical care about 8.5%. And then you have the core data, the CPI, which excludes food and energy as well. So of course we're going to be discussing oil prices with Brent and with WTI and how that's affected the markets, but has also had an impact on, also changed or slightly changed the view from investment banks and what impact it's had on those investment banks and how they feel about the Federal Reserve and their rate hiking path. But usually, when the economy is in a normal environment where there isn't a hiking or cutting of rates path sort of going on, then usually the seasonally adjusted month-to-month data is preferred. It shows you what's going on within the economy without the effects of weather, production cycles, etc. So usually it's just the month-to-month, the seasonally adjusted is seen as a way as to, okay, how much should CPI jump from one month to another? But in this regard, the Fed is looking at all inflation prints. So there isn't really so the month-to-month in this case isn't seen as preferred. It's everything all together. Whatever whiff of inflation rising here or there occurs, then that changes the sentiment for the markets. So the difference then between PCE and CPI, very simple. PCE inflation places a low weight on prices of gasoline and of residential rents and focuses on the nation as a whole rather than just focusing on the urban areas. Then how does it affect the markets? It's very simple again. Dollar, usually what happens is if you do get higher than expected data, then you get the dollar. Then usually the dollar strengthens. In regards to in a normal market environment where the central bank isn't hiking rates, then it shows the economy is growing. And then on the flip side, in this hiking environment, if you do get data that is stronger than expected or higher than expected, then you get the central bank then you get the speculation that starts to grow that the central bank has to do more work to rein in inflation. So then also the other thing as well with the stock markets, the underlying inflation or core data again is quite key for the markets to see is inflation actually coming down or is it still quite strong. So when you do get prints sometimes where data is in line with expectation or slightly below or above, that can rock the market. But in general, in this tightening environment, all the data is still important to look at, whether you're trading the stock indexes or currencies or bonds, whatever asset it may be. So usually higher than expected data is bearish for the stock market, and because it shows that the central bank has still more work to do, meaning rates may stay higher for longer, or they might continue raising rates when the markets might have previously expected that the central bank might have finished raising rates. For bonds, high inflation reads can lead to high yields in an expansionary environment and also in a tightening environment as well. Again, there are two bits of sentiment. So yields can rise because of inflation going higher and the central bank and the pricing in of the central bank having to do more work in the future. And then the flip side, it's if the economy is doing well and prices are rising nice and steadily, then there is the expectation that you will have more you will have more investors that will move away from the bond market and then will jump into the other riskier assets instead to get more of a return, because the economy is doing well and there's more confidence within the markets. Hence, you get the move away towards the stock market or the risky assets rather than staying in the safe haven assets, such as the bond market. All right, so the previous report then for what we'd seen in July. So the index for shelter was the largest contributor to all monthly increases, which accounted for over 70% of the increase, with the index for motor vehicle insurance also contributing. Over the past 12 months, index for all items excluding food and energy rose by 4.8%, and with shelter accounted for a significant portion of the increase, along with motor vehicle insurance, recreation, household furnishing, and operations and new vehicles. Then, if we look at where the economy is at the moment, so you have non-farm payrolls, which remained unchanged at 187k, or the net amount of jobs that was created in the prior month was 187k. Unemployment rate ticked up as well to 3.8% compared to 3.5%. Average earnings slightly ticked down to 4.3% compared to 4.4%. Employment costs at 1%. PC price index year on year ticked up 3.3% compared to 3%. As did the core CPI data, also ticked up. It went to 4.2 compared to 4.1. ISM manufacturing prices paid also rose as well to 48.4, and then the services, the more unstable part of the economy, doesn't really, because of how services are. It can be very erratic with data, but it rose to 58.9 compared to 56.8. Productivity was at 3.5% compared to 3.7%. Import prices at 0.4% compared to minus 0.2%. Export prices at 0.7% compared to minus 0.9%. PPI was at 0.8%, and core PPI was unchanged at 2.4%. Then the triggers for the economic release. So what are analysts expecting for the highs and lows? So they see the month-on-month with a high estimate of 0.7% and a low of 0.4%. The year-on-year with a high estimate of 3.9% with a low of 3.4%. Core month-on-month with a high estimate of 0.4% and a low of 0.1%. And the core year-on-year with a high estimate of 4.5% with a low estimate of 4.2%. So in general, when we've seen the previous market reactions, what's happened is that when there has been a slight deviation here or there on one of the readings, that has still caused a market reaction. But when you get a bigger deviation, then of course you see a bigger market reaction that is more sustained. And then when we look at the previous release, the one previous to it had seen a much bigger reaction compared to, and the one that lasted for longer, rather than where there was a shoot up rather than the S&P shooting up and then taking or raising its gains that it had made in that short time frame within about 10 minutes or so. But that's something to be aware of. So again, still quite important, even if there was a slight deviation with any of the economic releases, you can still get a reaction, albeit not as strong as if you have bigger deviations, or if you have deviations on all the economic releases compared to their forecasts, then you get a much stronger reaction. So then if we look at the sentiment and views, so first of all, we have Goldman Sachs CEO Solomon, who said that the Fed still has work to do on inflation, and the US economy is likely to avoid a significant recession, but inflation is likely to be more persistent than market participants currently expect. With high oil prices, again, that's something that we've experienced in the past, when oil prices have climbed significantly. If we remember back to the beginning of the Russia-Ukraine conflict, that had, of course, obscured and made the headline figure for inflation much bigger than what it actually could be when we were looking at the core data or comparing it to the core data of inflation. So that's another worry that the Federal Reserve has. When you have higher oil prices, that could lead to higher consumer prices. But one of the things that could happen is if you do have higher oil prices, then the pump when you go to the pump, that means that there might be less demand for it. Maybe if let's say if the price of gasoline also rises, if that starts rising to back around $5, if that continues to rise, sorry, that could dampen demand. But in some cases, of course, if there is still a strong demand for those fuels and energy, then it could accelerate those prices even further. So, of course, with the high oil prices, when we're talking about what I'm referring to is, of course, you had the prices that jumped off of the back of Saudi Arabia and Russia, the world's biggest crude exporters, that said that they would extend output cuts by at least another 3 months. Then Bank of America's Blanche sees a $90 Brent crude price in 2024, adding that if you push too hard, the risk that is that inflation comes back, and then the narrative is that we're going to have to peak rates with no recession goes out the window. And then OPEC has to consider the effect on the macro market with rates and a potential recession in the US and the rest of the world. So this is another thing to contend with as well. If oil prices are too high and businesses aren't able to continue producing their goods or provide their services for those other businesses, then it's going to have an effect on what the central bank will have to do to try and keep inflation down as best they can. But in return, they could induce a recession if they were to do that, unless they saw the rise in oil prices as transitory. But we know in the past when they've said transitory, actually hasn't been that transitory. There has been a bit of stickiness with oil prices to a degree. I'm not saying that it's completely embedded in the reports, but it does stay there for a while because, of course, it takes time for businesses to attune to the new prices of energy or fuels that they need to use, and then that feeds back in to what consumers get for their goods or services. Then JP Morgan's Kelly said that higher oil prices also, of course, feeds in the inflation psychology, and that there is no price in America better known than the price of a gallon of gasoline. So when gas prices rise, Americans often regard it as a sign of runaway inflation, leading to a lower consumer confidence and greater business caution. Okay, Fed and government views. So you had Feds. So first you had the New York Fed 1 year ahead inflation expectations, which rose to 3.63% compared to 3.55%. Fed's Logan said that it could be appropriate to skip an interest rate increase in September, but skipping doesn't mean that they're going to stop raising rates, or it doesn't imply stopping rate hikes altogether. Fed's Goolsbee added that we are very rapidly approaching the time when the argument is not about how high should rates go, but rather how long rates stay or have to stay. Fed's Collins says that the rise in yields may reflect the idea rates may stay high. And then Fed's Powell said that the Fed intends to hold rates at a restrictive level until they're confident inflation is moving sustainably down to the 2% target. So there are two things that we need to just be aware of with the Fed. And again, going back to the oil prices, if the oil prices have a longer term effect on headline inflation, then I think, it's a personal view, then I think that the central bank might decide to continue raising rates if there is a longer term effect. But it also depends on what OPEC what OPEC Plus does with their oil output production. Do they in November? Do they say that they're going to continue extending their cuts, or do they say that they're done in November and that's it? There might be maybe a month or two of data where you have higher headline inflation reports. Again, that's speculative, and we're not going to predict what Russia or the Saudis are going to do, and how long that they're going to, or if they're going to want to extend their cuts for longer than what markets and economists might be predicting it. Also, the governments as well around the world. Then market pricing, what we've seen so far. So CME FedWatch showed no change. Well, this was yesterday. It was like it still showed no change from the Fed next week. Fed swaps shift full pricing of a rate cut to May from June. Originally, it was in July, so this is a while back. But it's important to understand that because of course this is before the Saudis and Russians decided to extend their output cuts to 3 months ahead, or 3 months longer. This is what the expectation. It still is, or more or less, that markets are expecting a rate cut to happen in May. So again, as I said, originally it was in July, but as data was doing what the Federal Reserve wanted it to do, i.e. a dampening of inflation, the jobs market is also seeing a bit more weakness that it has seen, or losing that strength that it has had over the past couple of years or so. That's helped the Fed's narrative of maybe that they just need to stick with rates of where they are, and they probably need at some point start cutting those rates if the effects of the jobs market, or if the effects of raising interest rates quite high, or keeping them there for quite high for too long, starts to have more of a material effect on the economy as a whole than what the Fed would have expected it to do, i.e. putting the economy into a stagnant position, or the worst end for it to be put into a recession, or a dip into recession. So let's look at the previous release then for the data. So if I kind of just skip back a little bit. All right, so you can see, so with the data here back on August 10th, the data more or less was in line with expectation, and only excluding, if we're looking at the deviations sheet, only excluding the year-on-year, which had seen which was the only one that had seen a decline of about 0.1%. So here's how the release comes out. See that there was a bit of there was strength in the stock index, stock indexes, let's say, and the weakness from the dollar. Off of the back of that data, as said, it all came in line with expectation, except the CPI year on year. And if we're comparing it to the prior figures as well, that's also a cause for concern. So if on top of the forecast figures, there should also be a focus on the prior figures too. How does the actual figure compare to the prior figures? Because here in this instance, you can see CPI year on year was lower than the expected forecast figure, but comparing it to the prior, of course, it still went higher. So in this instance, usually when data is in line with expectation, with the exception of one going either way, up or lower, then you still get a reaction, but within 10 minutes or so, that market reaction, that initial movement that you see, doesn't last that long. In some cases, and the last time around whether we had the CPI data, and after about 10 minutes from the economic release, it was down 24 ticks on the S&P, but 30 minutes after the economic release had occurred, or from the 30 minutes after the release, it was up by 39 ticks. So what that tells you here is that the markets took the decline in the year-on-year inflation as in a positive way, but then there are also the other figures that have come in line with expectation, which means that inflation might still be stickier than what markets might have been trying to price in for maybe inflation, what they wanted if they wanted inflation to fall further. Hence, you see that there's a bit of a moderation or quicker moderation on the stock index. So let me bring up the deviations. Actually, let me skip ahead and show you. Yeah, there we go. So this is the, where are we? It's to be about 15 minutes after the economic release. So you can see that the S&P didn't really hold on to its initial gain with that data there, because it didn't blow it out of the water, or all the data wasn't in one direction, whether it'll be up or down. Usually when all the data is pointing in one direction, then it makes it easier to make a decision as to say, right, okay, which way should I go? But when data is more mixed or is flat, with an exception of maybe one data point here or there, then it creates an image, or it creates a scenario where the market reaction might not last as long, or might not be that strong as what you might expect it to be. So let me bring up the deviations. We've got about 8 minutes left towards the economic release, and I'll show you what I mean. So if we look at the deviations here, so last time around, as said here, all data was as expected, with the exception of one, and there was a bit more choppiness within the markets here. But if you look at the last time round on the S&P on the 12th of July, when data was headed all in one direction, you had you can see here that the movement in the same direction was sustained. Even after about 30 minutes, although there wasn't really that much movement happening. The blue brackets, in case any of you guys are confused. So you have different brackets here. So we have our first figure, which shows you the initial market reaction, okay, going to the wick of the candle. The brackets in black shows you the movement 10 minutes after the economic release. Usually in here, if there is a word that says up or down, or if there is a word in here in the brackets, it usually means the market's gone in the opposite direction. Okay, so first here it went up by 74 ticks, and then here it was still up. The market was still going in the same direction and is up by 90 ticks. If it said down 90 ticks, that means, of course, in that 10 minutes it had gone down, or after 10 minutes it had gone down by 90 ticks. Let me give you a good example of that, actually. I'm trying to see. Usually the CPI data has been quite nice and clean, so you don't really. Okay, so here, that's one example on the NQ and also in the S&P. So you can see that on the initial movement, it had a 149 tick move down, and then was up by 49 ticks on the 1 minute candle, on the first candle, and after about 10 minutes of trading, it was then down by 34 ticks. Hopefully that makes sense to you guys. If it seems complicated, let me know, and I can make edits to the way it's presented to you. But hopefully this thing at the top here that I've made here with the key chart, or with the key, should make it easier to understand. So again, you can see when you see data that goes, all the data is in one direction, that makes it easier that means usually, historically, what we've seen here, you get a stronger market reaction. On the flip side, if the data is as expected, then usually what happens is the market reaction is more mixed, or it could be more muted. So in an example here, back in January, the beginning of Jan, you can see that when the data was all in line with expectation, you had a initial market reaction, but then after 10 minutes of trading, that market reaction was kind of more or less wiped away. That initial move, or it reverses its initial move, should I say? So that's another thing to be aware of. So today, the key focus, as I said, would be everything, and we need to just be aware of the choppiness in the market reactions that we could get. If the data is mixed, then it's something that I'm not going to touch. If there is clear data and everything's going in one direction, then that'll make it easier for me to say, right, okay, maybe I can take this, considering how past data has shown that when the markets do go in, if the data does go in one direction, then the market reaction is stronger, rather than trying to jump in and piggyback off of the momentum, or try and make a prediction as to which way it might go. Or it's just trying to, or maybe it's seeing which way the markets are going to go, and then try to follow that with the momentum, and also using TICKSTRIKE to see how strong is the buying or selling momentum within that asset. All right, so about 3 minutes ago now, the deviations sheet, if you're wondering how do you get your hands on it and what you can do, all you got to do is subscribe to the mailing list here. The deviation sheet is completely free, and you'll get that on the Monday when I send out my next email to you guys. Now, in that email, as I said, you get the link to the deviations sheet. You also get a small short summary of what to expect for the week ahead. And when I say that, it gives you a short summary of what's going to be happening in Asia, the US, and the European session. Again, very small, not a lot of detail in there, because I provide you guys with the information here and with the detail. Woo, let me get this out of the way. What have I got here? There we go. Okay, just going to set up my releases. Apologies if I'm kind of going quiet a little bit. Got about 2 minutes left to the economic release. Okay, 1 minute to go now. Right. Let's see what occurs. Okay, 10 seconds. $3.7% higher than forecast, or 3.6%. So data stronger than expected there. Core CPI month on month with spot 3% higher than forecast of spot 2%. Okay, let's see how this goes. Okay, so weakness in the S&P. So we'll go here. Let's try and claim it. Okay, we also had the core year-on-year at 4. Let's move that out of the way. Core year-on-year, core CPI year-on-year was at 4.3% as expected. And the core month-to-month, and the CPI month-to-month was at 0.6% as expected. Okay. Okay, so core month and month was also, as I said, core month and month higher than expected at spot 3% compared to spot 2%. And the core year on year was as expected. CPI year on year, as I said, ticked up to 3.7% from 3.6% as from the forecast. Okay, dollar seeing strength, the S&P seeing the weakness there. Okay, let's see what gold. Gold is also seeing some weakness there. All right. Okay. Okay. It's not going to work. All right. Cool. Okay. So let's have a look at FinancialJuice. So what FinancialJuice is all about, you have your live voice and text service. So for day traders in particular, when you're looking at the markets and something goes crazy within the markets, maybe there's been a bit of news that has occurred, then having a live voice and text service there is there to make sure that you know what's happening. So if there has been a bit of text, maybe Fed's Powell has said something, then what can happen is that that you'll be able to understand what's going on and then be able to manage your position from it in as soon as you can. Okay, so the feed or the link to that here for FinancialJuice, there is a 7-day free trial of FinancialJuice that you can have a little play with, and that link is here in the chat. So again, particularly if you're a trader who's keeping an eye out on what's going on in the markets, yeah, it's probably a good idea to stay out of that trade or get out of that from then earlier rather than stay in it. So as said, with the economic releases that we can see here, it's also live in real time as well, and you have the week ahead data that is there for you, so you can also have a look as to what to expect for the week ahead, and see what the markets might be, what you could expect from the markets. Is it still trying to hold up? Okay, yeah. All right, that's it. Not going to jump in again. Leaving it as it is. Let's see. So yeah, so as I said, having a live voice and text service is there to help you to manage your risk, and also keep you, and also as a day trader, is also to provide you with the potential opportunities that the markets could present to you as well. So again, if you do want to subscribe to FinancialJuice, then you can, as I said, you can get a 7-day free trial. First of all, make sure you have an account on FinancialJuice, and that you have an account. If you don't, then it makes it a bit more difficult to subscribe to the newsfeed. So once you've made your account, and if you want to go pro, and you verified your account through email, then click on the button where you can see here where it says FinancialJuice Pro. It will say Go Pro on the light version of FinancialJuice. And then once you do that, select your subscription, go back to the homepage, log out, and then log back in. And then you should be able to see what I see here. As said, you have your live voice and text service, which is in real time. Okay, and you have, you have the light version if you're using the free version of FinancialJuice. That has a delay to it. That it also has adverts as well. And as I said, you don't get the news in live and real time. So to capitalize on the data, you want it to be in live and real time. So then you can manage your trade and manage or capitalize on any potential trades. Also manage your risk as well in real time with the live voice and text service that we have. So there's that too there. Then TICKSTRIKE. So TICKSTRIKE, what it does is it allows you to listen into order flow. And another way to put it is it shows you the strength of the momentum within the market, so of the buying or selling momentum. So here what we can see is that when if there's a little bit of buying or selling that's going on here on the S&P, let me just bring this up here, then TICKSTRIKE will show that there to you. Okay, it will give you a visual and audio alert. And you can kind of chop and choose whichever you want. If you want a visual or an audio alert, then that's totally up to you. So this ticker box here, as said, it shows you the strength of the buying or selling momentum. And level 1, so you see these different numbers. So you see these different numbers here. -1 shows you the selling momentum, and then the one by itself without a negative symbol shows you the buying momentum. So this slider here is the sensitivity of the ticker. So level 1 is the most sensitive to market reactions. So when there's a little bit of buying or selling momentum that occurs, then TICKSTRIKE will pop off and give you a visual or audio alert. If you increase that level all the way to 15, 15 is the least sensitive to market reactions. So only when there's a big amount of buying or selling that is occurring, only then will TICKSTRIKE go off and show that to you there. And of course you can chop and change whatever you want it to be, whatever kind of works for you. So this lightning bolt symbol here, this makes it super sensitive. Okay, so this is going 15 levels below 1. Okay, if 1 is the most sensitive, then 15 levels below it is even more sensitive. Okay, so what we can see here, so level 1, so you can see it's just going off all the time. So it's more made for those who are scalping the markets for opportunities. But of course, if you put it to 15, then that's back to level 1 again. Reminds you of Harry Potter, the famous book series. Yeah, it does, doesn't it? But it's cool. So yeah, as I said, you have your lightning strike, which is super or uber sensitive to what's going on in the markets in terms of the buying or selling momentum. Okay, All right, so that's TickStrike there, and there is a 7-day free trial of TickStrike that you guys can use. There we go. I'm also going to pin a message here. That's for FinancialJuice. All right, so that's TickStrike. Also, if you like trading high probability stocks, futures, FX, and crypto breakouts in real time, then you can also join up with Unusual Activity here in the link that's provided. All right, there we go. Okay. I can't say it all on the stream, William. But yeah, so that's TickStrike there for you, and that's also the link to Unusual Activity. Now tomorrow we have the ECB interest rate decision. Okay, so again, we'll be doing the same thing like we did today, going through the live sentiment, or going through the sentiment and the expectations for the ECB and what they're expected to do at their upcoming meeting. Will they go for a 25 basis point hike if that's what more of the money markets are expecting, or will they decide to keep rates on hold instead? And we'll go through all of that tomorrow in the live stream. So I'll get the link for you there so you guys can join me for that as well. Let me grab it. Where is it? There we go. Okay, that is a link for tomorrow's stream. So that'll be at 7:45 a.m. Eastern time. We'll be going through that, the expectations for the ECB the next time for their meeting tomorrow. All right, thank you very much for joining me live. Hope you found it useful, and I will see you guys next time.